Good day to everyone. My name is Christopher Ng Chung. I'm the Early Retirement Masterclass Trainer, and today I'll be talking about investing in an era of high interest rates. All right. And for the overview of our presentation, we will be talking about specifically investing in this particular era where interest rates are being raised very quickly. Right. We will begin with a discussion on the macroeconomic backdrop, understanding the equivalent historical period in the 1970s, which I would term the Paul Volcker era, right? And I'll talk about why it is so challenging to invest in this era. And I'll be sharing with viewers the different approaches to investing in this very special time in our lives, right? Yeah. Okay. Now, why do I term this era the Paul Volcker era? All right, and this is very important because most investors have not lived through this time, which is in the late 1970s to the mid 1980s. All right, and what actually happened in the late 70s is that strikes in Iranian oil fields led to oil prices moving from $13 per barrel to about $34 per barrel. Now imagine that in that era in the 1970s, $13 per barrel is actually very expensive already. And it's almost, I would say, tripled, right, in value. And this energy crisis then triggered inflation, which hit double-digit values at the time, forcing Paul Volcker, who is the Fed chief at that period of time, to raise interest rates to 17.6% in April 1980, right? Really, really high, double-digit value. And the federal funds rate then peaked at 20% in June 1981, right? Imagine the interest rate on loans going up to 20% a year, right? Unprecedented, and it's probably something which our generation has never seen before. And this triggered a recession in 1981 to 1982, where US unemployment actually reached 10% in the US. But Paul Volcker is largely celebrated for actually moving inflation down from 14.8% in 1980 to 3% in 1983. All right. And I think this historical period is the period that is closest to what we are seeing right now as investors. And this is definitely not good news because if you look at even the training industry, look at a lot of trainers and gurus that you see on YouTube, a lot of them came from an era where you made a lot of money through buying momentum, right? Which means you buy tech stocks in the US and China for the past 10 years, you would have done very well. And this has also influenced a lot of financial advisors to put a lot of clients' funds into these high beta technology funds, all right? And that is a period of long summer that we have, all right? And if you're a guru of summer, the bad news is winter is coming. So we're going to next talk about the investing challenges in this Paul Volcker era, all right? And if you look at the kind of challenges that we currently face, this long winter that's coming, is that it is marked with repeated 75 basis point interest rate increases. And when the slides are being made, the latest increase is on September 2022. And when you're raising interest rates by 75 basis points, now most landlords cannot raise rents fast enough to be able to catch up with these interest rate increases, which means that even when you argue that real estate investment trusts, for example, are a good hedge against inflation, it may not be a good hedge against this kind of inflation, right? Which means that regardless of how you're positioned in the equity markets, right, we could be seeing a reckoning, right? Even with superior factor models that I talk about, right, I can help you improve your performance by 2 to 3%. But if the overall markets drop by 15 to 25% a month, right, that would be something that could be very challenging for a lot of investors. So what I intend to do for this very challenging presentation is to talk about how we can proceed in this economic climate. And I think to survive, right, you will need to be both greedy and fearful, right? It's not good enough to be totally fearful because it means that you cannot catch the bottom of the markets and you won't be able to benefit from the recovery that comes thereafter. All right, but you also cannot be too greedy Because if you do that and the markets get worse, you could be stuck with 20 to 30% losses, right? So that's something which I think a lot of viewers need to think about. Okay. All right, now let's talk about a little bit of theory and first principles, right, as to why higher interest hurts everything, right, with the exception of commodities, right? If you look at the standard 101 finance formula called the discounted cash flow formula, right, which is basically what almost every single financial analyst would attempt to do, project the future cash flows that we have, and then discount it to the present using a discount rate, right, to get the price of an asset, okay? So effectively what you're seeing is that when interest rates go up, the discount rate goes up as well. And when discount rate goes up, the intrinsic value of these assets all drop, and it drops across the board, right? From equities to fixed income, right? And the only thing you will not see drop so much is maybe commodities, all right? Because commodities simply do not generate a future cash flow, right? They're basically inputs to industrial processes. So from a little bit of first principles, right, you can already tell that this is going to be quite bad, okay? It's going to affect many of the kind of investments that you're going to have, all right? Yeah, so enough about doom and gloom. I'm going to talk about what you can do next, all right? Give you some investment ideas on how you can probably proceed, okay? And not to worry, and I think some of these ideas have a little bit of merit, okay? Now, the first solution I'm going to talk about is factor selection with an emphasis on value factors, right? And this comes from our knowledge that when market cycles are on a downturn, there are a few things that continue to work, right, regardless of where you are. And these are investments that give you high dividends, generally come with a low price to book ratio and a low price to earnings ratio. And this generally would allow you to produce superior results compared to retail investors, right? And of course, the other lesson is you try to focus on blue chips because blue chips are more robust, they're more likely to survive, okay? And so the discipline that comes from value investing with an emphasis on dividends, right, will be particularly useful at this time, all right? And we can do that on my next slide, which actually talks about market cycles, okay? So you can clearly see, right, if you look at the composite leading indicators for the OECD economies, right, 37 countries, I think, which are democracies and are very market-oriented, you find that their leading indicators are all trending down. They are all below the average of 100, and they're both trending down, which means that we are currently in a period of downturn, okay? Now, if you look at downturn and the kind of factors that have a tendency to do well, you find that low volatility, high dividend yield, profitability, and value, right? And these are the kind of factors that we do focus on in my early retirement masterclass. They have a very strong probability of outperforming, all right? So this is where I think you can actually play in the markets if you can put your money into stocks. And on top of it, you will find that because real estate investment trusts have been beaten down so badly, right? On the next slide, I will show you and demonstrate that current yields on the 1st of October have become extremely valuable, all right? And if you look at even something that is very Singapore-oriented like ESR Logos REIT, right, which is a industrial REIT, it's giving 8% dividends, right? You imagine looking at a bank account that can build by buying these real estate investment trusts and just parking in your CDP alone. If you were to buy all of them on this list together without really thinking very much about their fundamentals, you should be able to get something very close to a double-digit dividend yield. Okay, so and this is extremely important because when interest rates go up very quickly and landlords are not able to match the rise in interest rates, right? What happens is that the real estate investment trust will start behaving like bonds, which means that the dividends become like fixed income, right? And if you start behaving like bonds, what is going to happen is the bonds with a lower duration, right? The bonds with a lower duration have a tendency to do better than bonds with a higher duration, right? And when that happens, you will find that the real estate investment trusts that give out a higher dividend, right, would actually have a tendency to do better. So this is a very good place for you to start betting, and hopefully you will do better than other REITs in the same local space. So this is one good area for you to play at. All right, and of course, for me and my students, we will go deeper than just the quantitative considerations. We will drill into some of the more qualitative considerations when you look at these REITs. All right, the REITs giving 8% are special situation plays, and some of them you need to look at things like quality of management. All right, that's really unavoidable. But reducing it to a set of 12 stocks to look at is not too difficult to do that. All right, so let's move on to our second solution. Our second solution is we want to think about stocks that do well when interest rates rise. Okay, and one very obvious solution when you want to look for something that goes up with interest rates is banks. And banks benefit from higher net interest margins when interest rates rise. So, for example, if you have a mortgage with a bank, when interest rates go up, you end up paying more for your mortgage every month. Okay, so very logically, banks would definitely make more money along the way. All right, so that's something that you want to think about if you want to invest in stocks. And obviously, our three big banks are DBS, OCBC, and UOB. They're highly correlated with each other. So if you don't have capital to buy all three, buying one of them would not be functionally very dissimilar to buying all three. All right. Now, do take note that banks are no guarantee in that there are some other areas of the business like wealth management may decline if a recession were to actually occur. All right, so always look into other parts of the business, but generally I think the net interest margin is going to go up, making it a very, very strong candidate, right, for a local play. The next item which you want to consider are consumer non-discretionary stocks like Sheng Siong. And Sheng Siong is a grocery company that sort of operates in the middle income and lower income groups. And that's very important because you notice that for people who have a very tight household income, right, high inflation is going to force them to actually skimp, right, on restaurant visits, even eating in hawker centers. And you will find that a lower disposable income might force them to spend more on groceries and home cooking. So something like Sheng Siong and all that would put you in a very strong position as interest rates go up, right? But this is generally if you believe that a Singaporean household would actually feel the pinch, right, from high inflation. But we are generally a very affluent kind of country, all right? So whether that would happen or not, it's based on how optimistic or pessimistic you are. But I sort of believe that this is likely to come true if we see more interest rate increases by the end of this year and early next year, right? Now, do note that when you were to buy equities this way, right, doing well just means outperforming the rest of the equities market. It might not mean that you might actually make money, because if the overall market might drop and you might do better than your peers by about 5 or 6%, you might still be seeing a little bit of losses, all right? So just make sure that you're mentally prepared that if you're betting on equities for the following year, okay, there's still no guarantee that you would come out ahead, okay? But I think these are very good places for you to bet on, okay? All right, I'm going to show you some evidence on my next slide that talks about rising interest rates and why I believe that banks will do well. Now, if you look at the period of rising SIBOR in the past, right, you find that interest rates rose from January 2015 to January 2019, okay? And what I can do is that I can take this period of time and backtest the performance of banks during that period. And so on my next slide, you will see that, okay, if you were to backtest banks against the rest of the STI, okay, you will find that banks actually do outperform, okay, during the period of 2015 to 2019, which actually explains why I'm so bullish about that particular argument that I have. Okay, yeah, so this is a fairly strong conviction from someone who has all these quantitative tools. Okay. All right, so let's talk about my next solution, all right? And my next solution generally is to tell leverage investors to actually hold back on leverage and reduce leverage to just one. Keep your dry powder in a margin account after markets bottom out. And when interest rates stop rising, right, and the markets retreat sufficiently later, maybe in the middle of 2013, you might be able to basically come back with guns blazing, all right? So this might be a time for you to hold back right now, okay? And in my next slide, I'm just showing you what my previous batch of students have done. So my students come into class, I teach them a little bit of finance, but I turn them into financial analysts for me. And what they do is that they will all come into this web app to do a little bit of data entry, and then the system will automatically generate a page like this that shows a regime plot of the kind of portfolio they're building. And clearly you can see that the drawing is all red, okay, on the chart, which means that this is really not the time to really go high on leverage, okay? But when it turns green, right, you need to sort of be prepared with a margin account, with some money and dry powder ready for you to immediately leverage to about 1.5 to 2, okay? Yeah, and so this basically is the kind of portfolio, very, very conservative portfolio that my program is trying to build. And even so, right, the signal is saying that, you know, you might want to hold back for a while, hold your horses, but remain invested for the nice 5.4% dividend. But when the time comes, right, you want to be ready to be able to come back with your guns blazing. All right, so that's my third solution. All right, let's move on to my fourth solution, which is basically to dollar cost average and perform time diversification. And the reason why this is important is because I'm not a huge fan of dollar cost averaging, right? It's something that a lot of financial advisors talk about. The reason I don't like dollar cost averaging is that your money is not put in the financial markets, okay? Yeah, but this time it's different, okay? Because we're facing a market bear, it is not wise to put all your money into stock markets at the same time, all right? So what you should do is that you should divide your funds into at least maybe 10 to 18 parts, and then invest every month, okay? Invest every month to catch the market bottom, right? While you might experience some losses over the short and the medium term, if you successfully catch the market bottom for this interest rate increase, it may well make you a millionaire, all right? So like what has happened during the Great Recession, that's how I generally made the bulk of my money, all right? So it's extremely important. That's why I say you have to be fearful and greedy at the same time. Fearful enough to do dollar cost averaging, but greedy enough not to give up on the markets, all right? So put your money into small little parts, and as the markets were to drop, right, make sure that you buy more and more units of the kind of stocks that you want to buy from the stock market, all right? So that's something that you might want to do. Okay, let's look at the next slide. And generally, this is a reminder that typically when a crash were to occur, right, we can look back and find out when the next peak is, which is 3,445 points for the STI. And until the recovery from the stock market, which is 10% bounce from the bottom, right, based on whatever I've discovered using my quantitative tools, that will happen 2 years from the peak, right? So if you think about it, it's already October, and the peak was in April. So that's about 6 months that have already passed, which means that if we do end up crashing, right, we are highly likely to recover about 1.5 years from now, which is why I've spoken about breaking your money down into 18 parts and investing every part one by one, all right? So that's more or less one of the good ways in which you can find a way to recover from the rest of the markets, all right? So this dollar cost averaging, even though I'm not a huge fan of it in the past, I'm already telling people that now is a time to bring back this discipline, all right, into your investment portfolio. Okay, and finally, all right, my last solution is integration with government schemes. Remember that when we are in this period where there might be a downturn, we want to look for guaranteed ways for us to make money every year. And there are two schemes which are particularly important. One is the CPF Retirement Sum Top-Up Scheme, which allows a working professional to put in $8,000 into your CPF, right? And that's very important because the money is put in your special account, which gives you 4%, all right? And the supplementary retirement scheme that allows you to set aside $15,300 every year, that allows you to buy local counters on the stock exchange. Now, this is particularly critical at this point of the year, all right? Because if times are going to be bad, why don't we take more defensive measures to actually guarantee some tax savings? So imagine if your tax bracket is about a double-digit number, about 11.5%, and you're able to set aside, say, $20,000 every year into these tax-deductible schemes. You could be saving $2,000 the following year on top of the 4% you get, right, from your CPF special account, on top of the 5 or 6% dividends you get from your dividends portfolio. So this is very, very critical in this bear market, in that you find these government measures to actually help you save as much money as you can. All right. And if you look at my next slide, right, which I typically show by students, is that if you're like me, a sole proprietor, then you can actually take your money and spread it across 3 different accounts, right? Your ordinary account, your special account, and your MediSave account. And for someone who's age 45 to 50, the average interest rate I'm getting is 3.22%, right, in my CPF. On top of it, the Singapore savings bonds right now, when the slide is being made, returns only 3.21%. Okay, but that is a 10-year commitment. Like for me, I'm a 48-year-old. Within 7 years, I should be able to see the first tranche of my CPF come back to me. So not only am I looking at higher returns, I'm looking at a shorter tenure, and I'm also looking at tax benefits from doing voluntarily contributions for my CPF. So this is something that you should not miss. At the end of the year, try to look for money, and find a way to contribute to your CPF as much as you can. All right. So in essence, right, in conclusion, I basically talked about all these ways to cope with the extreme challenges in an era of rising rates. Okay, an aggressive recovery is somewhere at the end of the rainbow, right? There is light at the end of the tunnel. Okay, even though you're going to see a lot of tightening over the next 6 months to 9 months. All right. So to summarize what I've spoken so far, invest in high dividend yielding counters, banks, companies that deal with non-discretionary consumer goods. All right. So Sheng Siong, which is a grocery, is a classic company, right, that can benefit as interest rates go up. All right. The next thing you want to do is that don't rush to put everything into the markets immediately. Do it piecemeal over time so that you're guaranteed to catch the market bottom. All right. And finally, this is a good time to review the government schemes that are open to you. And you want to minimize on your personal income taxes next year. Okay? And finally, as a gentle reminder that you can't actually come out with stuff like this unless you invest in your financial education. And that is the best way to capitalize and exploit these features in this capitalistic society that we live in. All right. So with that, that is the end of my presentation. Thank you very much, and I hope to see you in my next preview.